Real estate investment opportunities. Where to find the gold mines. Investing in real estate is often described as one of the most reliable ways to build wealth. But for many, navigating the world of real estate investment can feel overwhelming. From inflated prices in booming urban centers to complicated financing options, real estate investments can be intimidating. Potential investors often find themselves asking, where are the true opportunities in this crowded and competitive market? With so much at stake, identifying gold mine investments shows promising returns beyond the ordinary is the ultimate goal. Despite the allure, real estate investing isn't without its challenges. For starters, finding affordable properties in competitive areas feels like searching for a needle in a haystack. The market is saturated with buyers vying for lucrative deals, and some properties that seem promising can quickly turn into money pits. Add in financing complexities, changing market conditions, and unpredictable property values, and it's easy to understand why investors hesitate. But here is the exciting part. Gold mine opportunities do exist. With a strategic approach, it's possible to uncover high-yield properties in unexpected places. In this guide, we'll reveal the secrets to locating real estate gold mines, exploring overlooked markets, identifying emerging trends, and harnessing tools and strategies that only the savvy investors know. Whether you're a beginner or a seasoned investor, these insights will help you navigate the market to uncover investments that others miss. The challenges of finding profitable real estate opportunities. Before we dive into how to find the best investment opportunities, let's take a closer look at why it can be so challenging to find those truly profitable deals. Market saturation. In popular markets, real estate demand often outpaces supply. Major cities and bustling metropolitan areas see immense competition, driving property prices to record highs. With so many investors eyeing the same prime locations, profit margins can shrink rapidly. Unpredictable market fluctuations. Property values can rise and fall due to factors like economic downturns, shifts in interest rates, and even unforeseen global events. A once promising area can lose its appeal seemingly overnight, leaving investors with depreciating assets. Capital and financing barriers. Securing financing can be difficult, especially for new investors without established credit histories or substantial assets. Rising interest rates and restrictive lending criteria only compound this challenge, making it hard to enter the market or expand a portfolio. Information overload and misinformation. With so much information out there, it's easy to get bogged down in trends, tips, and expert advice, much of which can be misleading or outdated. Investors can struggle to find reliable sources, leading to costly mistakes and missed opportunities. Or boutiques are often early indicators of gentrification. Where there's an influx of these establishments, property values tend to rise over time as the area becomes more desirable. Check local development plans. Many city councils publish development plans that outline projects aimed at revitalizing certain neighborhoods. Knowing which areas are slated for improvements can give you a head start in acquiring properties in neighborhoods with high growth potential. 4. Consider real estate investment trusts (REITs) for broader market access. If buying physical property isn't feasible right now, REITs offer a way to invest in real estate without the upfront capital and logistical challenges. REITs are companies that own, operate, or finance income-producing real estate across various sectors, including residential, commercial, and industrial properties. Diversify your portfolio. REITs allow you to invest in multiple properties or projects through a single investment. This diversification can reduce risk, as you're not reliant on the performance of a single property. Generate passive income. Many REITs pay dividends, making them an attractive option for investors seeking passive income. Additionally, they can serve as a stepping stone into real estate, allowing you to build capital before moving into physical property investments. 5. Explore short-term rentals in tourist-heavy areas. With the rise of platforms like Airbnb and Vrbo, short-term rentals have become a profitable option for real estate investors. Locations with steady tourist traffic, such as beach towns, mountain resorts, or major cultural cities, can offer high yields if managed effectively. Research local regulations before investing. Check the local laws on short-term rentals, as some cities have strict regulations. Knowing the legal landscape can help you avoid costly setbacks. Analyze seasonal trends. In tourist-heavy areas, rental demand can vary by season. Make sure to account for seasonality in your revenue projections and choose a property with enough appeal to draw visitors year-round if possible. 6. Capitalize on commercial real estate in smaller cities. While many investors are focused on residential real estate, commercial properties such as office spaces, retail locations, and warehouse can offer lucrative returns, especially in smaller cities. As companies look to expand into secondary markets, demand for commercial real estate in these areas often increases. Look for cities with growing business hubs. Smaller cities with burgeoning business sectors can present valuable opportunities. By identifying locations where startups or established companies are relocating, you can tap into the increasing need for commercial spaces. Benefit from long-term leases. Commercial properties often have longer lease terms than residential properties, providing stable and predictable income streams. They may also offer the potential for additional revenue streams, such as renting out advertising space.